Hi, everyone. It's time for my quarterly update with Philip Petursson, our Chief Investment Officer. Nice to see you again, Philip. Thank you for joining us. I really appreciate it.
Great pleasure to be here again, Rod. Thank you for having me.
Yeah. Now, we've done a number of these and we've had wonderful feedback from our clients, and I really appreciate your time because I know you're very busy. I know you manage billions of dollars, and I did say billions. I did notice, right?
Yeah.
Yeah. I know, and you don't even have sweat on your brow. I'm very proud of you.
Well, things are working in our favor, so our clients are happy. I'm happy.
Yeah, thanks, Phil. Well, listen, today I thought it would be interesting if we did a bit of a retrospective look. When we talked about a year ago, there was a lot of things happening. And the key word at that time was, I would say, would be the unknown. And nobody likes unknowns, whatever it is. So maybe, do you want to take us back to the environment? If we were talking March last year, what would we have been talking about?
Yeah, we were still talking about the prospects for a weaker economic environment through 2023 and potentially the R word. Now, we weren't calling for a recession at that time, but we were seeing some of the typical signs that lead to recessions: weakness in manufacturing, higher inflation, weakness in the housing market. And this is specific to the United States, and weaker exports. And so these are markers that tend to pop up that lead a recession. And so the view was 2023, we were, I hate using the phrase cautiously optimistic, but that's what it was. We were going into 2023 with some optimism, but still, we were aware of the potential for downside risks.
Yeah, also very interesting. If I remember that, the news was very fear-based, of course, and the R word, as you say, right? Recession was key. I think, recession was every second word if it was in a financial news, and justifiably because there was so much unknown. But when I think back to a year ago, I know what we were talking about was, inflation numbers that were coming in, above the 8% range, right? And that created a lot of that talk around the R word because how are the central banks, the Bank of Canada, the Federal Reserve, right? In Europe and Asia, all in Australia, how are they going to react? And maybe you can walk us through a little bit about what was the fear at that time, again, a year ago.
Certainly. And we almost need to go back a year or two before that, when we started to see signs of higher inflation creeping into economies in North America and around the world. And then you heard the transitory phrase. And I say the air quotes because the central banks at that point were a little too optimistic in that, don't worry, it's just temporary. It's airfares, it's used cars, and inflation's going to go away very, very quickly. Yes and no. What we saw was inflation continued to ramp up, as you said, a year ago, inflation was still quite high, but at the same time, it was on its way down. And so, yes, it was transitory in the sense that inflation was going away, but not over 3 months. It was more over 3 years. And so a year ago, we still saw higher inflation, but trending in the right direction, trending lower. And that's where we are today. And so if we think about what central banks did, at first they were hesitant to raise rates because they said, don't worry, inflation's going to go away fairly quickly. And then they were very aggressive in raising rates. And we have the overnight rate in Canada still at 5%. In the United States, their federal funds rate equivalent is 5.5%. But where are we headed? Right? When we think a little bit forward, yes, we've seen the rate shock. Now, with inflation headed lower, interest rates are going to gradually be heading lower as well.
Yeah. So, sticking to that theme, first of all, I wanted to congratulate you because last year would have been a very, very difficult market to try to navigate through in all aspects. And from individuals, it would have been them looking at the housing market, of course. Then they would have saw the shock at the grocery stores, buying anything that they wanted to buy, supply chain, trying to get anything. This is very unnerving. And yet you and your team managed to have exceptional performance last year. Tell me, how did you navigate all of those unknowns?
Well, thank you, and you're very kind. And I would say, as an investor in the funds, yes, we finished the year, and I was quite happy. As the portfolio manager, I do think we could have done a little bit better. But and I say that because even despite you're right, we enjoyed strong returns last year. We were a little bit defensive. Again, we did see some of those risks that could have led to a larger economic consequence that really didn't materialize to the degree that we thought. So we were I would say defensive for the right reasons, but not so defensive that we missed the upside of the market, right? And that's this balancing act. We have to be delicate about it, where we're saying, okay, well, we see some risk. We weren't calling for a recession. That wasn't our view, but we said, we do need to recognize some of the potential downside risks that could lead to a very disappointing market. So let's be a little bit defensive while still be in a position to capture 95% of the upside, or probably closer to 100% of the upside. But in case we did see that downside, we were prepared for that as well. So that's what myself and my team are tasked with. It's not always just be bullish, be bullish, be bullish. When there are reasons to be, we will be, absolutely. And we can talk about where we are today. But it's balancing that upside versus that downside potential risk, and finding some nice middle ground for the exact scenario that we had last year. We didn't get the downside that we thought, which is good, and we were still in a position to capture much of the upside.
Yeah, I can say on behalf of all of our clients, everybody's happy when the upside occurs. But the one thing that they want to know, and we want to know, is that we are protecting the downside. So to be a little bit on the defensive side, to maybe not capture the full upside because we're doing the right thing, I think it's a testament to the value that, again, that you and your team bring. So thank you for that, Philip. Now, you brought up something also very interesting there, is that, you alluded to perhaps being much more bullish at this time, because a lot of the things that were unknown 1 year ago that we just talked about, I would argue a lot of those things are more measurable today. Maybe not fully known, but certainly measurable in a positive way.
Well, exactly. And so what we try and do is identify the trend and the direction that we're moving towards. Right? So it's not what happened last year, it's where are we going over the course of the next year. So how have things changed? Well, when we started talking about what did we see last year, well, we saw we saw manufacturing slowing down, we saw housing slowing down, we saw the consumer tighten up a little bit. I call it a deconstructed recession. When we think about recessions, we say it's a big R, big recession, and it's all these things happening. Well, what we saw was pockets of recessionary activity in segments of the US economy or European economy or Canadian economy, but not all together. So you actually, some people called it a rolling recession. We call it a deconstructed recession, where it was part but not the whole. And therefore, it's a lot easier to manage through and milder. And you saw the response in the market as a result of it. And actually, that's carrying through to where we are today. And now, that while you never know for certain, or there's a great quote from Lemony Snicket's, if you ever read those books to your kids, but he said, you can never be 100% certain, but you can be pretty sure. And that's where we are right now. We're looking at the trend of economic growth in not only the United States, but around the world, and it's all on the upswing. Manufacturing is picking up, demand is picking up, exports are picking up, housing's picking up. And these are things that tell us we're in a new economic cycle of recovery that has, as far as we can tell, a very attractive runway.
Yeah, again, and I'm certainly not ever going to be able to sit into your shoes, but just some history on my side, and having done this job for 77 years now, it's history does repeat itself. But the one thing that does remain certain is that economies do continue to move forward, just at different paces, right? And I agree, looking forward. But I think as an investor, whether you be a conservative investor or a more aggressive investor, I think the outlook today looks very, very positive. Would I be right in that statement?
You're absolutely right. And it might not seem that way because we still have some negativity in the media that says, well, someone so and so is saying that we're headed towards a crisis, but there's no evidence to that. That's opinion, but it's not really backed by anything solid. When we look at the data, the data actually is quite solid. And in this environment, you have a much higher probability of a favorable outcome and a much lower probability of the downside, any potential downside risk. Now, I'm not talking about daily market volatility. That's just the norm. What I'm talking about is a severe bear market that usually comes with a recession. Well, the probability of that today is less than 5% based on all the data that we look at. So that puts us in a good environment. And yes, we're optimistic going forward because a lot of the downside risks are behind us, not in front of us.
Yeah, very interesting. That makes it, I mean, just to put some historical nature to that, is a downside risk, or what you call a bear market risk of 5% is about as low a risk as probably I've ever heard. Right? That means how optimistic we really are. Because I believe historically, most analysts would say there's usually between a 15 to 20% risk at any time of a bear market looking forward. Am I right in that?
Yes, but you're right. If you look at history, last 100 years of the stock market, you go, well, how often does a bear market happen? Well, it happens 25% of the time. Okay, well, there you go. So we have a 1 in 4 chance of running into a bear market. Well, hold on. What are the conditions around that bear market? It's like, oh, well, 90% of the time that happens in recessions. Okay, so before we say, are we headed to a bear market? Let's answer the question, are we headed towards a recession? And here you can say, well, what does a recession look like? Well, a recession has these 8 things that typically happen. Okay, well, do we have any of those today? We have one. Oh, okay. So it looks like there's less risk of a recession going forward, and therefore much less risk of a bear market.
Really great clarity. Thank you, Philip. I love the understanding. And again, I don't want to take up your time too much longer. There is something that is coming up in discussions today, and you will, I'm sure, be talking a lot about it throughout the year, because in November, there's a big thing that's going to happen in that country below us. And there's a lot of emotion around that. And it's important for investors to understand the difference between emotion and fact when it comes to economies, right? So there is emotions around all elections, particularly in the neighbor down south, right? And then there is the fact of how the economies are going. Tell me a little bit about what you would say we could expect maybe going forward this year, just based around those parameters.
Right. And I think we need to go back to 2016 and take lessons from the lead up to the election then, what people thought was going to happen, and then what actually did happen. The long and the short of it is that whoever wins the election, whichever party wins the White House, largely doesn't matter. On average, markets tend to go up, whether it's a Democrat in the White House or a Republican in the White House, the makeup of Congress. And so when asked the question, well, what does it mean for the markets if Trump wins or if Biden wins? Largely, it's like, it doesn't matter. What matters are the policies that follow. And we don't know what that's going to look like until we know the makeup of Congress itself. Is it going to be a split, meaning Democrats control one chamber and Republicans the other chamber? Is it going to be dominated by one party or the other? How are they going to work with the White House? So you can't do a plan for that. And again, even once we know the makeup of the House, you can't plan for it until you know, well, what is the actual policy that's going to be forthcoming? Rod, we often say what's said on the campaign trail stays on the campaign trail. Campaign trail is like Vegas. It doesn't matter because it doesn't exist until pen is put to paper and that law is passed through. So, but you're right. It stirs a lot of emotions. And I remember 2016 clients saying, if Trump wins, I'm selling everything. And as it turns out, that emotional response would have been the worst thing you could have done, because what we actually saw was a 14-month bull market straight up from the Wednesday after the election through to the end of 2017, largely unabated. Why? Because of the policies that followed, which were corporate tax cuts and deregulation. Will that be the case in 2025? Not sure yet. We'll see. But to say, well, if X wins, I'm going to do Y, that's the biggest mistake that we could make.
Yeah, great. Again, great feedback. So, Philip, listen, I'm going to end this today, but we'll always touch back again every quarter if you're up to that. Right?
Absolutely.
What I would like to do for all the people that are watching this is to remind you that you also, you do get commentaries that we put out that is really put together by Philip and his team. But Philip also does a podcast that has an exceptional following. It's one of the fastest growing podcasts in Canada at this time because of the down to earth nature and the ability for you to relay very complex items in a simple way, Philip. And I just want to let you know how much we appreciate that, how much our team appreciates having you in our back pocket, if that's the right way to say this, and also the friendship that we've made over the years. So I really appreciate the time. Thank you.
Thank you, Rod. Thanks for having me.